Hey folks, welcome to another edition of the What Does It Mean podcast. I'm Chris Versace, and joining me as always are my two comrades in arms, Lindsey Bell and Bob the Counselor Lang. Hey guys, quick question before we get started and get to our special guest, Jeff Hirsch, the publisher of the Stock Traders Almanac. I want to ask you real quick, how was your Thanksgiving?
It was really good. I had the in-laws here. I had my parents here. I had my sister and her kids and family here. So it was busy. And I'm kind of honestly happy to be back to normal, I guess. How about you guys?
I had a really great time with my family in-laws as well, too. A lot of kids around and a lot of food. And our dog, Tony, just was the star of the show everywhere we went. So we went to a couple of different houses. So I like you, Lindsey, just kind of ready to get back to normal. And I'm interested to see more of these numbers for retail that we talked about last week about how the consumer is doing. And I'm looking for bargains to hopefully get out and do some shopping.
I'm so behind on my shopping, man. I didn't do any holiday, like Black Friday weekend shopping, Chris. What about you?
Oh, Lindsey, come on. Really? I got an alert from USPS that I've got a raft of packages showing up today. So we got to get to today's conversation, because if not, I got 3 dogs that are going to lose their mind when the postal man shows up. We can't have that. So with that, folks, we are going to have a very special conversation today, as I mentioned, with the CEO of Hirsch Holdings. That is the one, the only Jeff Hirsch, publisher of the Stock Traders Almanac. We're going to talk about Jeff's views on the market, the importance of seasonal factors, and much, much more. Trust me when I say you aren't going to want to miss this. We'll be right back. I got to tell you, Bob and Lindsey, I am super excited today to talk to our guest. And I'm telling you this because I just sit back and I look at where we are coming off of the big Black Friday, Cyber Monday shopping weekend. We've had such a pronounced move higher in the stock market since we entered in November. The economy is vibrant, strong, if you believe the Atlanta Fed's latest GDP Now model update. But some folks, they're saying the market's short-term overbought. It's frothy. It's heady. I think we need someone to help us make sense of this. Who better than Jeff Hirsch, who's behind the Stock Traders Almanac? For folks who haven't heard of Jeff before, he's the CEO of Hirsch Holdings, the publisher of the Almanac Trader, and the editor of the Stock Traders Almanac. You can also find him, surprisingly, not only on X, but he's one of the few that I know who is making the migration to Blue Sky or Blue Ski, whatever the hell you call it. And you can follow him at Almanac Trader. Jeff, I'm so proud and happy to welcome you on the program. You and I have never met, so I'm very excited to get to know you, but I know you know Bob and Lindsey rather well.
Well, thank you so much for that kind intro. I think you and I have spoken, or at least exchanged information, ideas. Yeah, interesting time. Thrilled to be on. It is seasonality season. It's December. Everyone's talking about Santa Claus rally. I don't know. You're saying something about overbought? Looking at my investors' intelligence sentiment, looks like it's a little bit, a few more bears than there had been recently. So,
well, I do some work at the street, as does Bob. Lindsey is an alumni of that. So I kind of pay attention to what some of our brethren have to say, whether it's Doug Cass, Helene Meisler. Helene, of course, looking at the short-term S&P oscillator. I think that's where she's saying that the market might be a little near-term overbought. I'm looking at other indicators out there. Citibank, panic euphoria, flashing euphoria, CNN, fear, greed. And we've had like a 6% move in the S&P 500 since we entered November, 7% for the NASDAQ. So I can understand why some folks might be not bearish, but maybe cautious.
Well, sure. And, you know, that sets up pretty well on the calendar. Beginning of December tends to be a little bit weaker as tax loss selling kicks in and just sort of the respite after November gains that we've seen at the beginning of the last 6 months. So the first few days of September, the first handful or so are not fantastic until we get into the mid-December period when the small caps kick in. So we have a market that's been up a lot. We had a lot of bullishness out there that's come off a little bit. I think that sets up a contrary indication of a turn there. But, correction, yeah, but not much. I'm thinking new highs. My forecast for 2024 that I made last December for 15 to 25% gains is in the bag already. I've upped it. I think we're going to end up at 30% like on the S&P and NASDAQ. My only concern or my only wish this holiday season is for some significant new highs on the Russell to get some firm out of the small caps. And we get into small cap season right here, which used to be the giant effect. So I don't know, some of the seasonal stuff I'm looking at right here.
Hey, Jeff, moving ahead. Now here, this year we could have back-to-back 20% gains in the S&P 500. The NASDAQ obviously have 50% in 23, up another 20%. What does the history tell us about the next year, about 2025, off of those really strong gains in the market the prior 2 years?
Gains beget gains. It doesn't mean another 20% gain, but double digits or low double digits are not possible. I've already forecasted 8 to 12% for 2025. I'm starting to see the negative post-election year comments coming out there, but people like to go back into the old almanac data, which goes back to Andrew Jackson's time, 1833, the old Cowles Commission stats. I'm sure Lindsey's got that book on her shelf. But
not that one, Jeff. I'm waiting for you to sign it and send it to me.
Oh, I wouldn't put a mark in that book. That's in plastic. But it's a new world. Things have changed as I write in the 2025 almanac, the post-election year edition. Post-election years have gotten a lot better since World War II. And since 85, believe it or not, it's the best year of the 4-year cycle now. Slightly better percent change than the pre-election year, the third year, but one less year of gain. So we've seen things be more positive in the post-election year. And most of that negative 4-year cycle stuff concentrated in the midterm year.
So, Jeff, for a fundamentalist, right, when you're sitting there, you're saying, 8 to 12% next year. What's giving you the comfort, the confidence in that? And as you do that, can you just kind of explain to folks what the Stock Traders Almanac is for those who may not be familiar with it?
The Stock Traders Almanac is now in its 58th consecutive annual edition, same age as me. My illustrious late father was a legend. We lost him a couple of years ago, about 3, at the ripe old age of 98. So I was raised on this, born, bred, weaned on cycles, patterns, seasonality. He also taught me fundamental analysis and technical analysis. First, when I started working for him in the early days out of college or just when I came into the company, first thing he taught me was price to sales ratio. Everything else is manipulable. The Almanac is basically his brainchild. He was working at a place called Indicator Digest back in the early 60s with his cousin, my godfather, Sam Koslow. He wanted to take all of these cycles, patterns, indicators, and market stats and put them together in a calendar format so we could keep track of the market's schedule along with his own, hence the Almanac. It covers seasonal trades, different monthly patterns, the best 6 months, not selling May and go away, but you got to buy in October and get your portfolio sober, as I like to say. Big component of the 4-year cycle, sector seasonality, the intraday trading patterns. I used to run the numbers for half-hourly tick data out of the Barron's lab pages with a little ruler and a red pen and an adding machine and graph paper. There's a thing I put out, the Super Boom, which I forecasted to 38,820 on the Dow back in 2010. And it's one of those interesting patterns that he covered. But a lot's changed, but a lot stayed the same. You still see some of these intraday seasonal patterns still working. So it covers everything from intraday patterns to monthly seasonal patterns, quarterly patterns, options expiration. So anyway, that's the Almanac. But we also have the newsletter, which we give people guidance on with stock picks and ETF trades. But what we're looking at right now is, you're asking me about why 8 to 12%. I don't know if you guys got a copy of it yet. I think we were trying to get one to you, but we have some different post-election year seasonal patterns, all post-election years. The 5th year of presidency, we had a unique election year. We had the second time in history somebody running again after being ousted. We've got our aggregate cycle, which is a combination of all years, post-election years, and the 5th year of the decade, which has another different pattern there. So between all of those historical presentations, seasonal patterns, and with what we're seeing on the ground with, you were saying a strong economy. I've been using the word resilient to be a little bit, we look at Atlanta Fed, and we have our 5 disciplines where it's fundamental, seasonal, fundamental, technical, monetary, and sentiment. We've got a lot of technical confirmation. We've got some underlying fundamentals here, at least in the U.S. corporate results, economic results. Nothing's perfect. So it all adds up to a continuation of the bull market. And with my super boom outlook, looking for upwards of 60 some odd thousand on the Dow over the next 48 years or so, I just finding it difficult to get bearish. So, it could be something that rocks things.
The way we try to architect things it's be mindful of, or at least I should say I shouldn't say the three of us. I have tried to zero in on these multi-year structural tailwinds, but I try to be cognizant of the landscape in the near term as well, right? So like, for example, you were saying how the first few days of December may not be as strong. You have to wait for the small caps to kick in the middle of December, you were saying. I'm sitting here going, wow, we're about to get some potential ISM services data that could show the services economy being really strong. That could take that Atlanta Fed GDP now 3.2% number, move it even higher. And if we get that, geez, what's the risk to the Fed delivering that rate cut the market expects later this month? So that's kind of where I'm coming from.
I hope they don't deliver it personally, but that's my opinion and assessment. I think we don't need it.
Do you think they need to deliver it, or do you think they should wait given the 75 basis points in cuts they already delivered?
Twofold answer. I think they need to do it for their own to save face, because they said they were going to do it pretty much, but I don't think they need to, and they should wait for more data. They did 50 out of the blocks. Things are still 20 to 30% more expensive than they were a few years ago. We all know that's not going to change. It's not going to come down. It'll stop going up and level. But people forget we didn't have inflation for a decade, honestly, for prices. So I don't think they need to cut. If I was going to bet, I'd probably say they will, but it's not action I really want to take.
I would say that I agree with you there. And I think the one thing that the Fed is worried about is the invisible man here. They're afraid of some sort of deflationary cycle getting started, and that they're going to have to get into some rate cutting mode with reckless abandon before the deflation. Remember, we saw that back when Janet Yellen, and I think that's certainly a worry for them. But I'm kind of in the same camp as you. Chris and I have talked about this a lot, and we think that at some point in time they have to stop cutting interest rates, because they're going to get to some neutral rate, which I don't think they know where it is.
What I would say too is I think that the market is becoming a little more comfortable with the fact that the neutral rate is probably higher than historically it has been. Even the Fed, every time we get the dot plot, they are increasing their view of the neutral rate. And so I think that the market and the Fed are both adjusting to that. But I think the question is, and we kind of debated this, was it earlier this year or maybe it was last year? Do we get to a point where, okay, the Fed is in a rate cutting cycle, which the market has favored all year long? Is there a point, people are talking about a pause, and I'm with you all that I think we don't really need a cut in December. But do we get to a point where we have to start thinking about an increase in rates?
Now, why do you say that, Lindsey? Are you saying that because of the sticky inflation that you've been calling out, or something else?
Yeah, the inflation does worry me. I don't see deflation on the horizon. I mean, deflation is obviously, like Jeff said, a very rare thing. So I don't know. That's one thing that worries me. But I also think that if we're getting a rate increase, it's because the economy is doing so well. Corporations are doing well, and the consumer is doing well too. So I don't know. That's just one thing I worry.
I think, correct me if I'm wrong, Jeff, Bob, I think the Fed's goal is to continue to extend the economic cycle, right? And I would say that what we saw yesterday on the prices front, when the ISM manufacturing prices component that came in way less than what people were looking for. I think the consensus was around a 55 number, up from 54 in October, and it was 50.2. I mean, that's a big drop. But on the other hand, the manufacturing economy has been contracting. So I could see, all right, softer prices there. So to me, the bigger question is, what do we get with the ISM services data for November? And what does that say about prices? That's going to be more important in my book.
I want to talk a little more about your small cap call, but because it's seasonally, like you're looking at the seasonality, you're saying that in mid-December, this is when the small caps get strong, and we're like about to, have we broken through yet? We got to break on the Russell 2000. We're looking to make the first all-time high in however many years.
Over 3 years. It was November 8th, 21, I think. We still haven't closed above.
Okay. And
As far as
so
I
if
can
we
remember,
do close above, how much confirmation do you need that that trend is intact?
I mean, technical analysis is a little bit of an art. Okay. So if it hits and closes above and falls out, that's not going to be great. If it does a little banner or flag or whatever one of those little patterns are and then goes back up, you're going to have a little hindsight.
And we were just talking about like how interest rates could remain elevated or the neutral rate is elevated.
Let's go back there for 1 second. I mean, the CPI, the old school inflation rate, last time I ran an average back to post-World War II was about 3%. We are below that. So I'm not sure what more neutral they're going to get. I mean, my older brother always tells me about when he bought his first condo back in the 80s. It was like a 15% interest rate on his mortgage. I mean, let's get real. The rates are pretty historically okay. They're not dirt cheap like we all had back in whatever, 2020 when we refinanced during COVID. But you're not going to get that. That's a once in a generation maybe situation. But so anyway, inflation, I think it's quite historically low, or at least manageable. Parts are still up, but the rate of inflation is okay. Anyway, back to the small caps. The seasonal move, there's something used to be called the January effect. People will be talking about it down in Sarasota when we're down there at the Marty Show. What we've seen and what Yale and I discovered over the years is that small cap effect, which used to be small caps outperform large caps in January, really starts in mid-December. That mid-December point we're talking about. You can see it on some of the charts I've posted out there. And if it doesn't happen, there's another thing with seasonal patterns, and they become indicators when they don't happen. We don't like the Santa Claus rally that Yale invented. If you don't get the Santa Claus rally, that's a warning sign. If we don't get a small cap rally in the last couple of weeks of December into mid-January, that'll be something we'll be concerned about, maybe even more than the actual level or breaking a new high. It's just if we don't see that annual buying spree, I'll be concerned. And then we run into our January indicator trifecta, the Santa Claus rally, the first 5 days, the January barometer, all based on the S&P. So we'll be looking at that in conjunction with the small cap move, as well as what's going on in some of the fundamentals and technicals. But everything I see is bullish. Save what Chris was talking about earlier about a little overbought here, a little correction in early December. It's just, I think that the one of the good seasonal indications to me was that mid-November dip that everyone thought of as a sell-off or called it the sell-off of the post-election rally, right? Well, look at the seasonal November chart. This tends to be a little bit of a dip ahead of Thanksgiving, which is that Thanksgiving trade that we like to talk about in the Almanac and when we out there in the social media and stuff. So that's set up nicely. That's confirming seasonals are still working. You guys remember Edson Gould, Findings and Forecasts, the old guy? Remember, I grew up with this stuff. So his quote was that if stocks don't rally during their bullish seasonal period, there are other forces that are stronger. And when that period ends, they will really have their say. So if we don't get that seasonal rally, there's something else is going on. Whereas on the inverse of that is if we don't get the sell-off like we didn't get this year in September, October, there's some more bullish forces that are stronger than seasonality underlying there. So that's where I think we're at.
That's really interesting. And I wanted to ask you that. You like preempted my question because I was looking at, I love your seasonal work, and Sam Stovall, but for a long time, he and I are obviously huge fans and of the Almanac and all that you do. But I was looking at the monthly stuff, and like September, I guess. No, September was way stronger than expected. Worst month of the year.
October, a little dip early.
October was a little bit worse than expected. And then November was an outstanding month. So it has been together a much better than seasonally projected type of period.
We call this a bull market. I mean, it is. There's a lot going on. This AI thing, I'll circle back to my superboom forecast, but this AI thing is what I call the culturally enabling paradigm shifting technology that changes the world, changes everyone's lives. And it's just starting. I mean, back when I was converting the paper spreadsheets to Excel for DOS and Windows 3.1, that was in the early 90s. That was sort of the similar point I think we're at.
Lindsey, for you and some others out there, DOS, disk operating system, preceded Windows, and it was a command line system. None of this graphical user interface nonsense.
I mean, that all was word soup to me.
So, Jeff, I was also going to suggest about one of these other calendar anecdotes, right? Is we're right in the middle, right at the start of this best 6 months of the year, we're already 1 month in. And that first month, I mean, is it possible that a lot of that good performance, Jeff, that we expect to see between November and the end of April was pulled up? I mean, did we pull it up, or do you think that we could just continue on with these ridiculous?
It's possible. I mean, I don't think we're going to get the continuing levels of magnitudes of gains like we had in November, but I'm expecting a few more percent here in December. January used to be much better. We've seen some profit taking in January. We could see a little bit of dip there. I write the forecast for the Almanac back in June, and then we're going to do our newsletter one just before Christmas to update everything. But we're looking for a bit of a pullback based upon the historical patterns in the first quarter and the third quarter of post-election year. So it may not take away from the whole best 6 months performance, but there's going to be some pauses. There'll be some pullbacks. We got that February's that weak link in the best 6 months. But you have the Ides of March, which tend to have some. I mean, it's a cute little saying because you got Caesar there and everything. And I just saw Gladiator in the movies, Gladiator 2.
Not as good as the first one. Not as good as the first one.
No, definitely not. But the Ides of March for the stock market is important because you got the end of the first quarter. And that's like institutions drive most of these patterns and they're very quarterly based. So that first quarter is a big deal.
So Jeff, I wanted to just to look back a little bit to help us look forward. And let's say we do have another positive month here in December to end the year. This will be 11 positive months in the year of 2024. At 11 out of 12, I think April was the only down month.
Yep.
And then if we go back and look at Donald Trump's first term, right? You remember 2017, every single month was up in 2017. So does that get you, is that what's getting you excited here about the opportunity, the potential to go higher in 2025?
It's definitely adding. I'm looking for the page of the Almanac here. It's definitely adding to my outlook. And we have all the charts of post-election years right here on page, what is it? 20 something. I don't know. Anyway, it's pretty solid. Oh, here it is.
I want to say 2017 was the first and only year that the stock market SP 500 was up every single month in the calendar year. Does that sound right to you?
I will have to check that, but it sounds like it could have been the case. And I could look it up here, but if you're saying it's probably true, but it's definitely worth looking at because that adds to that whole post-election year improvement that I was talking about earlier. I mean, it's part of it. The reason the market rallied and the reason the prospects for 2025 are bullish partially is the fact that we're looking at some pro-business deregulatory type of policy initiatives and agendas for the year. There could be some issues with tariffs and inflation. I mean, we're talking about the art of the deal guy. I think that's some negotiating tactics and the way he operates. But 2017, as you pointed out there, Bob, was the way it was because of all of the pro-business stuff that got initiated.
So Jeff, you seem very bulls up, I think is a fair way to say it. You've got your super boom and longer term forecasts. But when you look at these seasonal patterns, let's say over the next 6 months, 12 months, something like that, what would give you pause, right? That would say, oh, this is not panning out the way I thought. Are there factors that you would be willing to share that might say, these are my signposts?
Other than the fundamental stuff and technical stuff, since I'm the seasonality, person here, first thing would be the small caps not making a new high and not rallying like they should during the small cap effect or the January effect. Santa Claus fails to call. Bears may come to Broad Wall. Yale's line right out of the page 116 of the Stock Traders Almanac. First 5 days down. January barometer down. Full month January barometer. We get a negative January indicator trifecta. That's not good. So that's where I start to worry and I'll start to adjust my forecast. Without it, we start seeing some inflation ticking up. We're seeing the Fed hiking rates, that sort of thing with inflation issues, or even if they have to make some dramatic cut because the economy is falling apart. Those are the kinds of things that we're looking at. Right now, I don't see that. Using the longer term outlook, and again, going back to the best 6 months. If we don't get a positive best 6 months, that's a negative indication. That means that there are other forces that are more powerful that are overriding the seasonals. And I'm talking October 31st through April 30th, the whole span, not a negative month, not a pullback, not a 10% correction, but the whole period being down. But the midterm election year pattern, I'm not always a bull. We were bearish in 22 at the outset and piled onto it. And then when everyone was freaking out in October of 2022, we dialed up some Yale Hirsch and the bear killer bargain month stuff that he wrote in the 69 Almanac. And the sentiment was negative and everyone was throwing in the towel. And that's the typical midterm bear market bottom. And we had it. There was very few people that were bullish back then. And the 4-year cycle has been so on point since COVID. I mean, it's really tracked very closely. You guys know, and we can illustrate that. But my concern is that there's going to come a point where it doesn't continue to track. These things happen. In the late 90s, everything was straight up. There was no downs. So I'm leery for something happening here. But at this point, it looks like the bull market goes on, and we'll probably end up getting a bear market garden variety 20-30% one in sometime in 2026.
So Jeff, that's the market, but you also said you had this newsletter where you talk stocks, ETFs, and things like that. Are there particular sectors that you're warming up to? Not necessarily small caps per se, but market cap, irrespective. Is there any sectors that you're, like I said, feeling a little more comfortable with or think have better prospects?
We like the technology sector for the rest of whatever. I own some biotech. That got oversold, I think, because of RFK and some of the healthcare stuff. Energy is probably going to get a little bit of a, like the XLE type sector stocks because of the increased drill baby drill type mentality with the Trump administration. I think that sets those two up for being a little oversold. I doubled down on my IBB position personally because it got knocked off when I said biotech's kind of part of the future. It definitely needs to get reeled in a little bit. There's a little bit of nepotism and cahoots between government and pharmaceutical industry, as we all know, but I think there's a good value there. So, I mean, other than the seasonal trading, I think those are a couple that have presented themselves. We're looking for the small caps to show us something, though.
All right.
We're going to be keeping our eyes on those small caps for sure. One other thing, too, I'm just curious. I mean, we know that it seems like the cycles between bull and bear market are kind of, at least from bear to bull market, seem to be shortening, right? Is that what your work is showing? Or I don't know if there's any insights that you have that you want to highlight on that.
I think that's a very accurate observation. We've seen that over the years that bear markets are shorter and shallower as a rule. We've seen a lot of short ones over the past. The COVID bear market was a perfect example of that. And we do have a page on that in the almanac in the back. And you can see the time frames. It's bull and bear markets since 1900 for the Dow and 30 since for the S&P and then the 70s for NASDAQ. And yeah, those bear markets are fewer and farther between and shorter and less steep. We've gotten better at this.
And don't you think a reason for that would be since 1987, that Fed put that's been in place, that people are scared that they don't want to get too bearish because they're afraid that the Fed is going to step in there and start dumping liquidity in the market?
Yeah, I think that, as well as the circuit breakers and collars and mechanical systemic things that were put into place, helped that as well.
All right, Jeff, before we get out of here, I want to thank you for your time. Very fascinating, insightful. What's the expression? The trend is your friend. The seasonality is your friend and something to be mindful of. So I think folks should really take a hard look at what you've got in the almanac. If folks want to get the almanac, where can they go?
Well, I mean, it's available wherever books are sold, Amazon, whatever. I don't sell it on my website if I sell the newsletter, but if you want to get a free copy of the almanac, subscribe to the newsletter at stocktradersalmanac.com. I think there's still a Cyber Monday or holiday rate up there, holiday sale thing available. And that's pretty much where you can get everything. Traders Almanac.
Excellent. Well, I think some of our team will be down in Sarasota, Florida. Like you mentioned at the Money Show, we'll be making sure they follow up with you and see if anything changes.
Most definitely. Look forward to seeing you guys down there.
All right. Thank you, Jeff. All right, Bob and Lindsey, I'm pretty sure I am new to Jeff, not having really conversed with him quite a bit or anywhere near as much as I think the two of you have. I found that conversation very interesting because he brings to bear some things that sometimes I have to admit I don't necessarily contemplate. That's the seasonal trend, the seasonal factors that are there. And I'm really happy that I am getting a copy of the Stock Traders Almanac. I think once we finish this 3-week spurt here and we enter the back-to-back holiday weeks of Christmas and New Year's, I might actually put my feet up by the fire and thumb through the Stock Traders Almanac, because it sounds like there's a lot of pearls of wisdom that I could benefit from as an investor. What did you guys think of our conversation with Jeff?
Yeah, I would say that first of all, Chris, don't put your feet in the fire. But I find the Almanac interesting. I use the Almanac every single day. It's a fantastic tool for me because it actually shows you in print what sentiment is actually like. And what I thought about as we talked with Jeff today is, there's a lot of FOMO out there, which is the fear of missing out. A lot of people out there who want to get back into the markets are waiting for a moment where they can see the markets pull back, and it's just not happening. And the Almanac is a way of freezing some of that sentiment and telling you how people are feeling and thinking at a moment in time. This is what's so important about this presidential cycle. A good friend of mine, Tom McClellan, uses this as well too. The presidential cycle, it is so accurate and it is so informative about predicting where markets are going to be. So from my perspective, I thought it was extremely valuable for him to show us that information.
So Bob, we've been friends for a long time, and now I'm pretty mad that you have never for Christmas given me a Stock Traders Almanac in the past. How dare you? Lindsey, help me out here.
Well, now you have Jeff's email address, and he's probably on your speed dial, right? So he'll be sending you an almanac every year for the rest of your life.
We'll see about that.
I am surprised Bob hasn't sent you one because it's packaged so nicely. I wish I had one right. It's on my bookshelf up over there, but it's this big ringed book, and it's just packaged really nice. Each page, it's very clear and easy to read, and there's really some great quotes from some of the legendary investors in the world that are also included. So it's a really it is a great gift, I guess I would say.
I firmly have the fear of missing out now. This is not fair. I'm going to have to get one of these and report back. All right. Well, I know we've got a couple more podcasts that we've got to tape before we take a little break for the year-end holidays, but we'll leave today's episode there. And we would say, folks, we will be back with you soon. Please be sure to tune in. We always like discussing what we're seeing unfold in the market, various sectors, and of course, the witty banter. And I look forward to Bob's next Stock Traders Almanac saying, who knows what it'll be? Tune in next time. We will find out together.